Welcome, today we'll be reviewing 5 undervalued stocks for August 2025. Starting with none other than ASML Holdings, ticker symbol ASML, which is in the semiconductor industry. And now this company is not at their 52-week lows, but this stock has been suffering all the way since September last year. Since ASML sells lithography machines, which are very expensive machines used by microchip manufacturers such as TSMC, what has happened is that they actually got a lot less deliveries in that year than what they expected. The thing that ASML says is that these deliveries are not cancelled, they're just delayed and will happen in the following years. But we'll have to see how that plays out. With the information that we currently have, it does look like their valuation ratios have improved a lot since last year, as they were trading at a PE ratio of around 50 or even higher, and now their PE ratio is closer to 30. And one additional benefit that this company has, well, their dividend. They have a dividend yield of 0.8%, very consistent and very stable, with a 3-year dividend CAGR of 5.2%, which is not bad. Over here, we can see how their financials evolved due to what we commented earlier, where their revenue, gross profit, and net income have actually decreased in the latest 2 quarters. However, one positive thing to take from this is that both their gross margin and net margin have stayed pretty stable and have even grown a little bit over these 2 quarters. On the other hand, they have their cash flow evolution, which when you look at it year by year, it does look pretty consistent, pretty stable, but when you zoom in and you take a picture of quarter by quarter free cash flow generation, you can see that it's not really predictable and not really stable because all of their free cash flow generation is accumulated into a single quarter. But in this channel, we like companies such as MasterCard or even Visa, which have consistent growing cash flows every single quarter, as it just makes it a bit more predictable. But next, we can also see that their leverage evolution and their balance sheet is doing okay, with their total assets being way above their total liabilities, and with the ratio being maintained over the past 4 quarters. Next in line we have Lanthus, which is one of our holdings, and this is in the pharmaceutical industry. It basically produces and sells radiopharmaceutical diagnosis agents, which are basically if you're ever going to have a scan or a TAC performed, then chances are that Lanthus's products will be used in order to make the resonance and the whole analysis a lot better and more insightful. Well, it seems that this is not enough for the stock market, as its stock is down over 37% in the past year. Now, luckily for me, I bought in way before this, so I have been through the whole ride up and I've been following the stock on the whole ride down. I honestly have not detected any major setbacks from this company. I still hold it, I'm still very bullish on it. I know that they have a lot of growth in them. They have just had a bit of strategic missteps, especially due to the fact that they have performed a couple of acquisitions that the market has not really enjoyed, as the market was expecting high earnings in these years, and Lanthus, what they have done with these acquisitions is sacrifice some of their earnings in 2025 and 2026 in hopes for higher earnings in 28 and 29, which as a long-term investor I'm not really scared of. And as we can see their valuation ratios, their earnings did suffer a little bit last quarter, which is why their price to earnings ratio has grown a little bit, but overall it has been pretty stable and there are no major signs from this company slowing down. One thing to mention, this company does not pay a dividend, they currently reinvest most of what they generate back into the business. And over here we can see their financials, where in the latest quarter their revenues did actually decrease, and we have to take into account that the normal net margin for this company is around 25%, which is very solid. Then this is what I was talking about, the cash flows we like are predictable, where you can pretty much tell or have an idea of how much free cash flow they will generate the following quarter. And although in this case the free cash flow generation has been increasing for the past 3 quarters, this could still be considered relatively stable. And now when considering their balance sheet, we can see that they have over twice the total assets and total liabilities, meaning that they won't have to worry about debt anytime soon. Next we have LVMH, which is ticker symbol EPA, as it does not trade in the American Stock Exchange. But this is the largest company in the luxury industry, down close to 25% in the past year. Now this company is not known for their high growth, which is why their valuation ratios seem relatively low compared to other fast grower companies. For example, their price to earnings ratio over the previous 4 quarters has been at an average of 22 times. Now one thing they have going for them is their 2.76% dividend yield, which has been growing at a 3-year dividend CAGR of 5.8%. This is beautiful. And when we dive a bit better and look at their financials, we can see that their revenue has been decreasing quarter after quarter for the past year. However, their margins have stayed extremely stable, which is very solid and is a clear indicator that a company has competitive advantages and is the clear leader in the industry. when your revenues decrease and you're still able to maintain your margins. And over here we have a similar case where their free cash flow evolution is relatively stable and relatively predictable, where you get an idea of what the minimum and the maximum free cash flow that they're able to generate is. And when we look at their balance sheet, we can clearly see again that they won't have to worry about debt anytime soon, as their total assets are way above their total liabilities and have been so for the past 4 quarters. Next is United Healthcare, which has had a terrible quarter and has been bleeding since the start of 2025. Now, there was a lot of hype regarding this company saying that it was undervalued and that its business model was unfazed a couple of months back. I stayed on the sidelines because I'm not a big fan of their business model, and I saw that with rising healthcare costs, they were actually having a lot of trouble due to their very thin margins. And this has been the outcome. One of the largest companies in the US dropping by over 50% in less than a year. As we can see, their valuation ratios have normalized. They were trading at a PE close to 40 times last year, and now they're trading closer to 20 times, but their dividend is still shining. They have a 3.05% dividend yield, which has been growing at a 13.5% 3-year CAGR. So this is why I'm including this here, because at this time with this dividend yield and at these valuations, this company may be something to take a deeper look at. Over here we have their financials. As I stated previously, their revenue will always be more or less the same, as it consists of very recurring subscriptions, you could call it, as they perform insurance. However, their net income has a very low margin, which they have had some sort of trouble maintaining due to rising healthcare costs. As you can see, their net margin is close to 5%, and they have maintained it around there for a very long time because as a healthcare provider, I don't think they can charge much more than that without another competitor actually emerging and stealing the whole market share. Their cash flow evolution has been sort of suffering in the past quarters. They have been able to generate some cash flows, but this is nothing compared to what they used to generate a couple years back. And now when we look at their leverage evolution, they don't have to worry about debt anytime soon, as their total assets are way above their total liabilities. And last but not least, we have a company that has never appeared on this channel before, which is Marsh and McLennan, ticker symbol MMC, and they're basically in the professional services industry. They provide consulting, auditing, and even tax services to corporations and individuals. And the company is at its 52-week lows. They had an okay start of the year, but they started to lose all of that traction around March 2025, and now they're exactly where they started the year. Their valuation ratios have improved from around a 30 price to earnings ratio earlier this year, and now they're sitting around 24-25 PE ratio. They also pay a very juicy dividend with a 1.56% dividend yield, which has grown at a 3-year CAGR of 15%, which is an extremely high growth rate. And when we look at this company, their financials actually have no trouble at all. Their revenue has been increasing, their net income has been increasing, and their margins are way above what they were 1 year ago. However, it is true that in quarter 2 2025, their net margin is actually lower than the prior quarter, and their cash flow evolution is extremely stable except for quarter 1 2025. When we look at their balance sheet, we can also see that their total assets are way above their total liabilities. So what I think that actually affected this company is their projections and their insights for the following quarters to come. Now, having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.